We are looking at a negative tone for stocks, as I alluded to off the top there. The U.S. futures pointing to a negative start when we get going in about 30 minutes' time. Today, a lot of people woke up to the idea of a potential lockdown in Beijing. And obviously, we've talked about China's COVID complications. We know what happened in Shanghai. And now that there's an outbreak in a city of more than 20 million people, a lot of people are trying to figure out what that means for the global economy. We certainly saw the Chinese stock markets under tremendous pressure overnight. We saw that bleed into Europe trading. Investors have been looking for safe havens. That's led investors into the U.S. dollar, which has played a role in the weakness in gold. And staying with commodities, when we start thinking about the weakness of the global economy at a time when inflation is driving central banks to raise interest rates, all of a sudden, what had been the hot hand of oil has been losing momentum. WTI right now below $98 U.S. a barrel, and that's where we start our coverage this morning. Kumita Ramanathan has been tracking the oil trade and joins us with more details. Good morning.
Hi there. Good morning, John. As we saw, the Fed with its hawkish tone on Friday, we knew that Asian markets were going to essentially be on the back burner under pressure. But now with news that Beijing, in addition to Shanghai, is facing the threat of COVID, this is just going to be, a market that is just going to impact and rattle global indices. And that's exactly what we saw. Now, when it comes to the oil story, further pressure. China, of course, is the world's largest importer of oil and gas. As a result, what happens in China matters to the world. So right now with Beijing as well being under those pressures when it comes to sort of China's zero COVID strategy, that's going to have an impact on people who want to head out, who want to travel. They're not going to be able to do this. So including in Shanghai, they're saying that they're tightening the rules. So Beijing has one issue. They're trying to deal with the possible threat. Shanghai, very well established. There's rising cases there. Now, this, of course, also adds on to sort of the long-term impact for foreign entities who operate in China. Certain market darlings have been able to continue to have their factories resume production. Tesla's Gigafactory is still working under a closed loop, essentially making the workers operate indoors and live on site as well. But China's Foxconn, for instance, this is a major production contract manufacturer for Apple. They said they've had to halt production because of the fears of COVID cases rising locally in a number of their centers. Now, this zero COVID policy, as I mentioned, it's one that the government is not giving up anytime soon. And it might not be until we see longer impact on the economy in China to see any move. But right now, they're sticking to it.
The flip side obviously is that we are trying to figure out the demand-supply story, and clearly demand out of China is a key variable here.
Yes.
But the supply picture is still quite murky because we don't necessarily know, especially about many of those European nations that have been toying with the idea of moving more aggressively away from Russian supply, which at the end of the day was one of the big driving factors higher. I noticed Bank of America at the end of last week made a call that if you want to put your money in any equity market right now, look to Canada because of that bullish sentiment around commodities. So what is the broader sentiment around oil outside of these new developments in China?
Well, it's funny. I was reading one analyst note today, and they're saying in some ways, if you are an average consumer, the news out of China is kind of a good thing because it's brought prices down slightly. Even though we may not feel it immediately, it's a bit of a relief, if you will. There's also the bearish signal that Libya is going to be resuming production shortly. And why does that matter? Essentially, more oil coming to the market when there's demand lower, essentially, right? So that means that we're going to see prices low over the long term, but it's a mixed signal market and volatility remains paramount when it comes to oil because while overall, Western powers have been shunning Russian oil, there are Asian takers right now for cheaper Russian crude, and it hasn't had an impact in terms of the sanctions on Russia's economy so much when it comes to crude. So really a lot of mixed signals around oil.
Kumita, thanks very much for the breakdown. Let's get some more analysis on the markets in this early selling and the oil market reaction as well to that news out of China. Michele Schneider joining us, director at MarketGauge Group. Nish, always nice to see you. Let's start with the headlines out of China. Obviously, at a time when we're talking about higher interest rates to fight inflation, which was already seen as having this cooling effect on economies, the fact that they're still dealing with COVID complications in China is presenting an added risk to the global markets.
Absolutely. And even though right now the demand has slipped because of the shutdowns in China, we know that that's going to come back with a vengeance. That's been the pattern. But we've been saying all along, and I believe we've even discussed together, that oil is just one factor here, obviously an extremely important factor. But there is plenty of oil around, as you just mentioned, with OPEC potentially releasing more. So to me, the bigger concern really is the supply chain of other goods and still the nagging problem that we're going to see even more so, I think, once China does come back, and that is the food shortages that we're experiencing on top of a very uncooperating Mother Nature right now. We have, for example, the Southwest is on fire. Now, that's not a major growing region, but it's really, I think, shades of things to come that we're still in for tumultuous weather patterns that will not help farmers or crops.
We were using some sound from the end of last week on one of our programs last hour from Phil Orlando, a longtime strategist, who was building a case for investors seeking safety right now, just given some of the headlines. I alluded to the fact that right now you've got investors looking to things like the U.S. dollar, which as they gravitate towards something like that, you see a bit of a pullback in gold. And I only bring up the market flows because even the defensives, which had been a place where some investors had started to park their money recently, according to some analysis from Morgan Stanley today, which has been quite bearish on the outlook for stocks, that even those names are starting to look pricey. So again, Michael Wilson at Morgan Stanley has been quite bearish in recent months, but he's calling on more weakness for the S&P 500. What's your sort of near-term expectation for the stock market in the U.S., Michele?
Well, we're still sticking to a range-bound market, but we knew that we could look at about a 40% move from the peak of the market to about 40% lower, and we haven't gotten there yet in the S&P. If we look at around, if we just look at SPY, I like to talk in the ETFs, 380 would be an actual 40% move from top to bottom. Right now, there's probably some support just at the February lows, which were about 410. So we may see a little bit of buying against that. But unfortunately, I think what we're really seeing here is the end of the 60-40. As you said, people go into a liquidity crisis and they sell everything. But there will be opportunities, but they're going to be much shorter term opportunities. The idea that you're going to be able to buy stocks and sit and watch them grow to new all-time highs, I think right now is a theme that people should probably put in the graveyard and be much more prepared for getting involved in a dip that looks like some buying is coming in. And I never recommend buying a falling knife, but if we start to see some level of at least some substantial buying, let's say in the junk bonds, things that are more risk on, risk off indicators, then you have to get out once you get those bounces, because we're going to see these sort of bounces and then dips and bounces, then dips. The whole idea of a range-bound market right now, which is extremely alien to most, is what people really have to get used to if they want to actually invest in the market right here.
And does that mean, from your perspective, that the technology sector is going to be a worrisome one? As much as we have talked about it, less so for Canada because of this outsized influence of commodity stocks. I mean, Canada's technology sector has lost almost half its value this year. And there are a lot of people who are piling money into stocks like Shopify, and they've been pretty roughed up. It sounds like what you're saying is don't be surprised if there's more near-term weakness in that sector.
Absolutely. At some point, I think some of those growth stocks will be good buy opportunities. For example, we're waiting very anxiously from Microsoft, which is not experiencing some of the problems that other companies are having, like Apple and Google, that are still under a lot of restrictions now, and they're being monitored carefully to be able to control the flow of information. Microsoft, on the other hand, is involved in a lot of different areas that could have eventual growth, including metaverse, by the way. So if there's earnings this week is going to be key. All these growth stocks are reporting: Apple, Facebook, Google, Amazon, Microsoft. And so I would wait, obviously. But if Microsoft dumps another $20, $30 from here, it would be tempting to start a long position at that point. But otherwise, I'd be really cautious of these growth stocks. They've had their day. They had their day on low interest rates, free money, and that's all a thing of the past.
All right, Mish, appreciate your time as always. Thanks very much. Michele Schneider, director at MarketGauge Group. We will watch for some of those technology earnings as they cross this week.